Well, hi everyone. Shaun Humphries here. Welcome to All Things Retirement. Well, recently we hosted a live webinar dealing with the most recent federal budget. We had Eric Sikorsky, who's a CPA, walk us through some of the key changes related to the capital gains tax regime, the inclusion rate. But we talked about other aspects of the budget we thought were particularly relevant for you people. So I hope you enjoy the recording of this session. If you look at the description notes below the video, you'll find a link that will take you to a Dropbox file where you can grab hold of the complimentary budget summary review that we put together for folks. And as well, if you're beginning to think about retirement, there's a link there that will take you back to our homepage to talk about a complimentary retirement planning analysis that we provide, as well as a free retirement planning resource bundle. There'll be a link to both of those resources in the description box below the video. Anyway, wishing you all the best. Have a great spring. You take care. Bye-bye. Well, hi everyone. Looks like there's a few names starting to come into the webinar. So as you're coming in, welcome everyone to our live webinar on the recent budget that was put forward by the federal government. So welcome everyone. And so Eric, my first question for you, obviously a lot of the buzz on this budget related to changes to the capital gains inclusion rate. So maybe you could start there in terms of, just the key points on that part of the budget. And before you do that, by the way, most of our focus will be on those aspects of the budget that really pertain to individuals in terms of their tax planning, but also self-employed professionals. So we'll be keying in on some of those areas. So Eric, maybe you can share some thoughts on this capital gains inclusion rate.
Sure. You know what, Shaun, we've been preaching this for I don't even know how many years now about saying the capital gains rates could go up. They could go up for budget after budget, and it hasn't happened. And we were starting to, I think our clients were starting to tune us out a little bit, but it finally happened, but not quite in the way we were anticipating. The changes have tax professionals scratching their heads a little bit. But we can let's break it down a little bit and see how it impacts both corporations and individuals.
Okay, perfect.
So the capital gains inclusion rate historically for the past while has been 50%. So just as a bit of a background, if you have a capital gain, half of that gain will be included in your taxable income. Well, the increase to the inclusion rate has been bumped up from half to 2/3 for capital gains realized after June 25th, 2024. Now, this specifically is for corporations and trusts. So anytime we have a corporation that incurs a capital gain or a trust that incurs a capital gain, from June 25th onward, 66% will be included in taxable income instead of the previous 50%. For individuals, it's a little bit different. Individuals are subject to the increased inclusion rate only on capital gains exceeding $250,000 in any given year. So this means that individuals can incur up to $250,000 of capital gains every year and still be subject to the old 50% inclusion rates. But anytime you earn more than $250,000, those capital gains are going to be subject to the increased inclusion rate of 66.7%. One thing to note is each individual has their own $250,000 annual threshold. So this means for joint accounts or things like that, if it's joint and the income is split between, say, spouses, each individual will have their own $250,000. It's not on an account by account basis.
Okay. So can I ask you a quick question? I mean, you may be covering this off in some of your content. Maybe I'll just stop sharing for a second here as I ask the question. So that 250 level, and particularly given you can double it up on, if you Detroit individual as an example, on a year-by-year basis, for most individuals, they're probably going to still be at that 50% inclusion rate then.
Yeah, you're exactly right. And the federal government has said the people impacted by this, I think they threw out 0.7%. So it's a very small number. However, that number makes sense when you consider it on an annual basis. Year by year basis, there's not a lot of people that are triggering and realizing gains of over 250 annually. What that number does not incorporate are the individuals who might be subject to large tax events once in a while. Consider your upper, lower middle class family who inherited a cottage and they're selling the cottage. Well, guess what? This is obviously not happening every year. It's going to be a once in a lifetime tax event. And if their gain is more than 250, they will be subject to increased inclusion rates of 66.7% on the amount above 250.
Okay,
Another,
so it's going to be, people in situations where the cottage property example is a great example. There's probably a lot of people who've been kind of sitting on that transaction, thinking about it, but not really wanting to trigger it, and they've been babysitting it. Now all of a sudden, at least it's going to be tabled and voted on. So is there going to be a lot of scrambling potentially between now and the end of June, potentially? And, what kind of guidance are accountants and tax people kind of giving right now around that kind of issue?
so there was some initial scrambling when they first released the budget, but if you take a seat back and look at the whole picture, what we're advising is don't rush into anything. For many people, it will not make sense to preemptively trigger gains to use the lower inclusion rate.
Okay.
There are specific scenarios where it will make sense. Um, and just to give you an example, one of those scenarios might be if you were going to sell the cottage anyways within the next 2, 3 years, the kids didn't want it. You didn't want to keep up with the maintenance. So, we wanted to sell it anyways.
Yeah.
For those people, it might make a lot of sense to try and trigger the gains now so that when it is sold, or if you can sell it before June 25th, but when it is sold, the gain is minimal and you'll have little to no inclusion of the 66% inclusion rate and just be subject to the 50% inclusion rate that you will have triggered this year. So for those people who are expecting some sort of event, some big taxable event in the next few years, it might make a lot of sense to start looking at your options.
Okay. No, that's good advice. And I think that particular comment just sort of should be put over this whole presentation. So this presentation today is for general information purposes. We're going to cover off the main points we think are critical, but ultimately you want to sit down with your financial advisor or tax accountant or legal and accounting professional to get specific guidance on how these changes might impact you. But that's a good point. If there's imminent transactions, that might mean it could make sense to trigger some of this. Okay, let's go back to your slide that you prepared.
So in terms of any planning opportunities, again, this is a case by case basis. It's not going to be a blanket statement saying, hey, everybody, go trigger gains while there's a 50% inclusion rate. That's not going to apply for everybody. But let's take a look at corporations first. Now, remember, corporations are going to be subject to a 66% inclusion rate on every dollar of capital gain that's earned, right? They do not have access to a $250,000 threshold. So a lot of individuals, like small business owners who've been saving for retirement via their holding companies, may have amassed a sizable investment portfolio. Well, this portfolio is spitting out interest, dividends, capital gains. Well, now all those capital gains are going to be taxed at a higher rate. The reality is it's only about an 8% increase on the capital gain income. So don't rush out and do anything crazy. But we have people asking, if I'm investing this corporately, and I don't have a $250,000 threshold, should I look at taking money out of the corporation to invest it individually so I do have access to a $250,000 threshold? And in theory, that sounds like a great idea, but we need to remember to get that money out of the corporation into your hands personally, there's going to be some tax, like whether that's dividend tax or you bonus it out to yourself, never mind the capital gains on selling it inside the corp. So for a lot of people, paying that tax to get it out of the corporation, just have access to a $250,000 limit, probably won't make sense because it's going to eat into the capital significantly.
So they're kind of stuck. They'll continue to take advantage of the deferral of tax on unrealized gains, and then they'll meter out the income as they need it, but it may not make sense for them to do any major changes to their strategy.
Yep, you're exactly right.
I think that one of the points that's come up, and maybe you have an opinion on this, I mean, historically, the government, I think, on tax policies tried to kind of make changes somewhat neutral. You got things like the dividend tax credit and other strategies where if I'm doing something as a professional, but ultimately I'm going to be drawing that income out, personally for retirement income, now you've got this tax change that really doesn't harmonize between the professional and the personal, and I'm getting penalized maybe a year before I'm about to retire. All of a sudden they've changed the rules. Do you think that's going to be looked at? Because doesn't it violate a basic principle of tax policy?
You're exactly right. And that whole concept behind integration is
Yeah.
exactly like you described, right? If you should be paying the same amount of tax or close to under both circumstances. The reality is I don't know what's going to happen. But the interesting thing is we've seen since the budget came out, we've seen a lot of draft legislation on all some of these new policies. But what we haven't seen is any draft legislation on the capital gains rate inclusion increase. So, I don't know what that means. I'm certainly not speculating, but it could mean they're going back to the drawing board a little bit because, they've been the alarm bells have been going off from all the tax professionals everywhere saying, hey, wait a minute, this doesn't really make sense. So, would it be nice for them to come up with a threshold for corporations too, to level the playing field that way? Certainly it would, but I don't know what they're going to do. We're just going to have to wait and see what the draft legislation says. Again, say like don't do anything before that draft legislation comes out because
Yeah.
we don't know what the final rules are going to look like.
Okay. Good advice. Okay. Now you on the next slide here. Are we now on lifetime capital gains exemption?
Yeah, so that's another
Okay.
change. Yeah, I have a few more comments on the capital gains inclusion rate, but it ties into some future slides. So we
Okay.
can
Okay. Perfect.
we can talk a little bit about the lifetime capital gains exemption. Not a big change here, and one that's kind of expected, especially with the inclusion rate going up for capital gains. But the lifetime capital gains exemption, which is currently about $1 million, is increasing to 1.25 million. And if you're not aware, just explaining what this is. Basically, each individual is entitled to up to 1.25 million of capital gains exemption, meaning that portion of capital gains can be tax-free on the sale of certain qualified farm property, family farm corporation shares, or qualified small business corporation shares. So this is going up to 1.25, and then resuming in 2026, it'll begin indexing and increasing thereafter.
Okay.
So not a big change, but one that we kind of saw coming.
Now you had made some comments to me before this presentation on the Canadian Entrepreneurs Incentive piece. Any comments on that?
Yeah, this is kind of an interesting new proposal from the budget. So the Canadian Entrepreneurs Incentive is for anything that qualifies. The capital gains inclusion rate on that income is one half the prevailing inclusion rate up to $2 million in capital gains per individual over their lifetime. So what this means is the prevailing inclusion rate going forward is going to be the 66.7%. So if you sell shares and you qualify, only 33%, you'll have a 33% inclusion rate instead of the 66 for up to $2 million for an individual over their lifetime. Now, this $2 million limit, it's phased in over time of $200,000 per year until 2034 when the full $2 million will be implemented. So it's a little bit of a slow phase-in period, which is kind of odd. But just to kind of explain how this works, because it can get a little bit complicated, is if you're a small business owner and you sell shares that would otherwise qualify for, let's say, the lifetime capital gains exemption, your first 1.25 million will effectively be tax-free. Your next up to 2 million, once this CEI is fully implemented, your next 2 million will be subject to 33% inclusion rate. The next 250,000 will be subject to a 50% inclusion rate, which is that individual threshold that we were talking about. And then anything beyond that will be subject to the 66.7% inclusion rate. So it gets complicated, but this is a nice opportunity for those small, medium-sized business owners that have developed their business and have an opportunity to sell the shares. They'll be subject to lower tax on their exit strategy, which is a nice plan. But again, with a 10-year phase-in plan, like who's to say this will even be around in 10 years? I don't know, but right now it looks like a good opportunity. One comment I want to make, Shaun, though, to qualify for this, there's the typical qualified small business corporation test that must be met to achieve like lifetime capital gains exemption. There's a few other requirements for this CEI program, and they really just pertain to the business type and shareholder activity. So they want to make sure that the shareholder in question who's selling their shares was actively involved in setting up this business and actively worked in it for the first 5 years. And also making sure the business type is considered an active business in Canada and it's not a business solely reliant on the services of one individual. So think of your like professional corps, your accountants, lawyers, things like that. It's not designed to help those people out, but designed to help out true small, medium-sized businesses.
What do you mean true medium-sized small businesses? Aren't
One's
professional accountants and lawyers
active
close?
manufacturing. Yeah, no, I know what you mean. But yeah, unfortunately, there's a carve out for those people. They do not get access.
And I'll just make a comment. We've been focusing quite a bit about corps, self-employed, that kind of thing in this discussion. But it just happens to be very relevant for a lot of our clients. I think people on this particular webinar is probably pretty relevant for you. We will be covering off some personal planning aspects as well, and as part of this discussion today, but the corp side is key. So a lot of this, I think for physicians, they've been in the news quite a bit in terms of these changes. I guess the challenge they have is that no one's going to come and buy the shares of their professional corp, even if they can. That there's no value that resides there. It's basically just the assets that reside in their corp for liquidity and income. So do you have, I guess you're not in the prognostication business. There's obviously going to be a lot of pressure on the government, I'm sure, through organizations, association groups to revisit some of this, but there's not a lot of physicians as a percentage of the population. Not sure if they'll be successful in getting this changed in any way.
You know what? I don't know. They're certainly good at you know coming going to the news outlets and making it a big deal, because it is for them. Because I can't remember the original year, but there was a time when doctors were incentivized to incorporate and say, hey,
Yeah.
look at all this tax you can save because we're allowing you to incorporate. You can invest for your retirement inside your corporation. So they've
Yeah.
done that, presumably have built a nice nest egg for retirement. But now all the capital gains income that's going to be derived from that portfolio is subject to high rate tax. And they're saying, whoa, wait a minute. Why, you told us to do this, and now we're subject to this increased tax rate. There's a bit of a fairness issue there, perhaps, and so they're certainly doing their best to get the rules changed to help themselves out. And again, one of the things is maybe they implement a threshold for corporations as well. Not saying that's going to happen, but I think that would be a welcome change.
Now, when you were preparing for this, you share with me this idea of alternative minimum tax, AMT. It's kind of this, it's not rarefied, it's been around for a long time, but it is relevant, I think, to some of these discussions. So, did you want to just maybe introduce that topic in terms of the context of the budget?
Yeah, absolutely. So the changes to AMT were a big part of last year's budget. And basically, what it did was, if you're not aware, individuals will pay either your regular tax as it's normally calculated in your tax returns, or alternative minimum tax if it's higher than the regular tax. Now, most people won't be brought into this whole idea of AMT. It's really if an individual is high income and uses a bunch of credits and deductions to decrease their tax otherwise payable, they might be lumped into this alternative minimum tax. So the rules were changed last year, and some of the proposed rules coming out of this year's budget just softens the impact of AMT on charitable giving. So one of the issues was a charitable donation tax credit from last year's budget. You could only use 50% of it towards decreasing your AMT. So budget 20, which is kind of bizarre, but so budget 2024 has increased the charitable donation tax credit to 80% for AMT. Another
Okay.
comment of not necessarily what changed, but what didn't change, which is unusual, is the inclusion rate for capital gains on donated public securities still remains at 30%. So it was 0% under the old AMT rules, meaning if I have securities with an accrued gain and I donated them to a charity, I won't be taxed on any of that accrued gain. Well, now AMT will include 30% in the AMT calculation. So someone who might not have paid any tax on donating it might have to pay some AMT because of these rules. So what's not great about this is it might disincentivize people from making these donations because you don't want to pay tax. You're not receiving any money from it. You're receiving a tax credit certainly, but it might disincentivize people from making this donation because they'll be lumped into AMT. And then
That's an interesting one because we haven't heard, at least I haven't seen that one hit the radar in any major way, but that is a significant change. I mean, people are motivated to give to organizations or causes that they are invested in and feel are important, but the ability to do that without triggering any large capital gains, it was huge for people who've been babysitting securities or investments and then make the donation. So has it hit the radar in your mind around with clients when you talk to them or organizations? Because it hasn't been super loud at this point, I don't think.
like The reality is not a lot of people are going to be subject to this or be
Yeah.
impacted by donating this securities and then also having to pay AMT. Um, but these rules came into effect for 2024. So we've been running a lot of scenarios in the background for some clients who are proposing significant donations of securities because we're saying, it's great you want to donate it, but hang on a second. Let's look at this first to see what your AMT impact, if anything, will be on making this. And if there is an AMT impact, maybe there's something we can do to minimize that and still allow you to make the donation and just not be hit with this additional tax.
Yeah, it's one of those things where, I mean, maybe I shouldn't say too much about it, but if there's an area that you want to incent people, particularly during a period of, fiscal constraints by governments and all governments trying to find tax revenue, if you can incent people to give to causes in a way that doesn't punish them from a tax standpoint, I think should be a policy that's pursued. To me, this is, I think, really contrary to the direction that we want to be going in. But anyway, that's my opinion. Okay, let's go to the next area. Did you have anything else to add on AMT at all?
Yeah, just there's been another carve out for AMT that wasn't previously there in the old rules, and that's if there are any trusts that are established for the benefit of Indigenous groups, community, or people, they'll now be exempt from AMT. This was just an oversight in the original drafting. Some of these trusts were being lumped into these rules when they otherwise shouldn't have been. And before we move on from AMT, I want to tie this back to some of the capital gains exemption stuff that we talked about earlier, because if you are considering triggering gains, to get your 50% inclusion rate, if it's significant enough, you may be happy, right? I get my 50% inclusion rate. Great. I lowered the tax that I would have otherwise paid, but you might now be lumped into AMT because of the rules are changing as of 2024. So we have people who are considering, liquidating their portfolios to lock in that 50% inclusion rate, but we're also saying, hang on, that's not the only tax you're paying now. You're also going to be lumped into these new AMT rules. So if some of our listeners are not familiar with AMT, it's a prepaid tax that is refundable over 7 years. So as long as you're earning income over the next 7 years, you can recover some of that prepaid tax instead of having to pay tax. So it's not the end of the world, but we want to make sure that if someone's being lumped into AMT, number one, they're aware of it and the cash is available to pay it. But number two is that they have an income sources over the next 7 years to be able to recover it, right? If we can't recover it, then it's basically just an extra tax, and we probably ended up paying more tax than just being subject to the 66% inclusion rates. So it's just something to be aware of. There's a lot of moving pieces with respect to crystallizing gains before the rates go up. So, definitely talk to your professionals and say, look, I'm thinking of doing this. I'm thinking of transferring the cottage or selling the cottage or crystallizing gains. What's my impact? How much tax am I saving? And number two, am I going to be subject to AMT? Because this can be a surprise when you actually go file your tax returns and your accountant reaches out and says, hey, look, you also have AMT to pay, and you might say, whoa, where did this come from? It's a complicated calculation, so definitely recommend talking with your professionals before doing anything.
Yeah, there's these unintended ripple effects, right? You try to accomplish one goal and you create another problem. So getting advice on those issues is really important. Now,
Shaun,
yeah,
before we move on, I just wanted to make sure that I did mention it because again, this is tied to capital gains rates.
yeah,
But we've run some numbers, and we might have people asking, look, like, should I do it? Should I not do it? Like, I'm not sure if it makes sense. The reality is, the break-even point for prepaying tax at a lower rate versus paying tax at the higher rate is anywhere from 5 to 9 years, depending on your rate of return. So what I mean by this is, by choosing to prepay tax now, if you decided, you know what, I'm not going to prepay tax, and you took the tax otherwise payable and put it into an investment generating, X percentage per year,
yeah,
you'll make back the extra tax you pay within 5 to 9 years. So this really comes down to, if you're not expecting a big taxable event within the next, 1, 2, 3, 4 years, you're probably better off just staying the course, continuing to invest, because you'll have that additional capital to generate whatever extra taxes you might have to pay in the future if you were to sell in, say, 6 or 7 years.
yeah. That's a good point, because again, it gets back to some of the initial discussion points. I mean, there's a sticker shock or the shock about the changes, and now people feel they have to scramble to get something done by June 25th. But the reality is it depends on your timeline. It depends on your call on the capital when it's needed. And I think that crossover point or break-even point calculation is really important. It gives people guidance on, does this make sense? So that's a
Yeah.
good point.
One of the timelines that just no one knows is when you're going to die. And in Canada, when you do die, you are deemed to have disposed of everything you own. So that includes all capital property. So this is another situation where people who otherwise, might not have to deal with a higher inclusion rate might be subject to it, because if you own a cottage, maybe a couple rental properties, you have a portfolio, well, guess what? You're deemed to sell it on death.
Yeah.
So um, that's another situation where a lot of people are going to be lumped in. And if you're, if you're in your 90s, your health isn't good, or something like that, then it's kind of morbid to think about. But you might want to look at triggering gains now at a 50% inclusion rate, if because if you were to pass away in a couple of years, you might be subject to the 66.7% inclusion rate, and your state will have less after-tax cash available to pass out to your beneficiaries.
Well, I think that that's a great principle generally in planning. You look at income leveling or bleeding out tax costs. Sometimes it makes sense to do that just because the overall cost over your lifetime might be more beneficial. So it's having that ability not to make knee-jerk decisions today, but looking at your lifetime and what decisions make sense over that time period as best we can. I mean, tax laws change and the environment changes, but again, that's very good advice.
Mm-hmm. Yeah,
Um,
the capital gains rates have changed. I want to say about 5 times since they were first introduced. So um, the rates as they're currently being proposed won't be around forever. I don't know how long, especially with maybe a new government coming in. We'll see what happens there. But uh, are they willing to change it and go back on it as as a platform? Maybe. So who's to say how long it's going to last, anyways?
Yeah, I think if you were a new government coming in, probably your preference is you don't want to have to make a change. You probably want to, just in case you needed to
Mhm.
leave the higher inclusion rate in there because you're strapped for cash, you can blame it on the other government.
Yeah.
Because that's the reality. Governments are really tight fiscally, and there's going to be this ongoing pressure to find tax revenue. And I think that the unfortunate thing about this, I mean, I'm not sure your position on this, but I think that tax policy has such a huge impact in other areas. I mean, if you look at this policy as it relates to attracting physicians to Canada and trying to attract people into the profession, clearly this policy gets in the way of that. And yet we have a shortage of doctors. You look at entrepreneurs and business people who are trying to build businesses, or if we're trying to attract capital to our country for investment purposes, these policies are detrimental. And so you kind of get a short-term win as a government, right, in terms of tax revenue potentially, but there might be a very large long-term cost because you're creating disincentives for capital to come here. And we're already seeing pretty marked productivity gain differences between the United States and Canada. And the only way you can make up for that is reinvestment in human capital and capital and technology to make up for it. And these kinds of tax changes get in the way of that. It's got this negative ripple effect. Anyway, just me and my soapbox, but hopefully future governments will see that and try to balance off the need for cash today, but the need to reinvest back into the economy for the future. Now, I know you had some comments to make on the RRSP home buyers plan, correct?
Yeah, that's right. Again, this is a small change, but does have an impact to a lot of individuals who are looking to buy their first home. Um, simply put, the withdrawal limit was currently set at $35,000 that you could take out, but that has been increased to 60,000. Now, I certainly can't speak for everybody, but a lot of first-time home buyers, especially in the Manitoba region here, many of them probably don't even have 60 grand in their RSPs to be able to take out to put towards a new home. Perhaps in some other provinces where first-time home buyers might be typically a little bit older and have more of a chance to save, uh, might use this. But we'll see what the impact this has. But anyways, it's a welcome change anyways. And the 15-year repayment period would start in the 5th year following the year which the first withdrawal was made, instead of currently it's the second. So this kind of makes sense, right? There's a lot of expenses that come up in the first few years of home ownership. So this just allows a little bit more of a window until you have to start actually repaying into your RSP. So a welcome change, but we'll see what its impact is.
Yeah, little incremental changes. I think those kinds of changes, again, from a family perspective, when we talk about these things, what I encourage our client families to do is to think in terms of the family if they're motivated that way. So you realize that the kids might have these opportunities. You're trying to jumpstart them into, a home, and maybe you can collectively work as a family to help the kids kind of seize upon these opportunities. So you're right. There's probably not a lot of, people in that first-time home buyer market that might have that capital in place. So there might be some collaborations that will happen with families to make that happen. Um, Now you had as well made some comments when we were debriefing about this webinar about our ESP enhancements. Again, this is a family journey, and there's been some enhancements to our ESPs.
Yeah, so this is a great change, but they've now changed it so there's an automatic enrollment in the Canada Learning Bond for eligible children who do not have RESPs open for them by the time the child turns 4. So the Canada Learning Bond is a way for the government to provide funds for low-income families and their children to eventually use that money to go to school. And previously, you would have had to A, know the program exists, and B, apply for it. So now this is all happening automatically, assuming, of course, the parents file tax returns and file them indicating that they have children. So this will all happen automatically. The accounts will be opened. Funds, if the family qualifies, will be automatically deposited into their account and can be used by the child when they eventually go to school. Another change is the budget extended the age from 20 to 30 years to retroactively claim the Canada Learning Bond. So you don't need to do anything ahead of time and say like, hey, look, I might use this in 20 years. But basically, it just increases the retroactive claim. So for those that decide to go to school later, maybe closer to their 30s instead of right after 18, it just opens the door to more families to be able to use the funds for post-secondary education. So a
No,
nice
perfect.
change.
Yeah, I think there's any time that there's a policy change that incents those kinds of things, that, I agree. That's a great thing. Now we're going to kind of tilt back into the more rarefied area for some of the people on this webinar, and that's again getting back into assets and capital cost allowance calculations, that kind of thing. So let's talk about that. And there might be some people on our webinar that where it's relevant for them in terms of the accelerated capital cost allowance. Any comments on that?
Yeah, a lot of people are looking at different ways to diversify their investments. We hear a lot about people buying rental properties or building rental properties. Well, there's been some changes to
Yeah.
help encourage that. It might be a minor change, but it's something, and this is related to purpose-built rental housing. So CCA, or in other words, depreciation, it's an expense that you can take against your income. For class 1 is being increased from 4% to 10% for this purpose-built rental housing. And so this includes units that have at least 4 private apartment units or at least 10 private rooms or suites. And all or substantially all the residential units are long-term rentals. So this cuts out the Airbnbs. If it is a long-term rental building that you're building and you meet the criteria, you'll be able to deduct 10% of the cost on an annual basis instead of the current 4%. Secondly, again, we're taking a little bit of a different asset class we're talking about here, but for productivity enhancing assets, so this is class 44, 46, and 50, think of anything to, that enhances your ability to, whether it's in manufacturing or anything, if you increase productivity by investing in IT, I'll call it in general, or anything like AI, it allows you to have immediate expensing for new additions. So if you buy it, you can expense it in the year you purchased it in, as opposed to having to take deductions over time. So this provides an immediate impact to put money into this type of productivity enhancing equipment.
Okay, perfect. And I know that you had made some comments. There were some changes in the budget or adjustments to the Canadian or the Canada carbon rebate for small business specifically. And I think you had put together some information on that area as well. What were your comments on the carbon rebate for small business?
So a lot of individuals may have seen this on their tax return, that they're getting this Canada carbon rebate. It's been around, it's been called different things in the past, the climate action incentive and whatnot. But basically, the finance was proposing that now the Canada carbon rebate is available for small businesses, so not only individuals like in the past. CRA is going to automatically determine the tax credit for an eligible corp, and this is as long as they file their 2023 tax returns by July 15th. And this includes eligible Canadian-controlled private corps with under 500 employees and captures the 2019 to 2024 fuel charge years. So you don't need to do anything different. File your corporate return as you normally would, and CRA will determine and automatically apply the rebate for you. And it's based on the number of people you have employed, the provinces that they work, and a payment rate specified by the Minister of Finance of that particular province to try and figure out how much was paid and how much you should be entitled to as a rebate. So nothing you need to do, but it's a nice extra rebate that you might see for small businesses moving forward and not only individuals.
Perfect. That is a really good around the world tour of what we thought were some of the key changes that impact clients on the budget. Eric, thank you for walking us through that high level summary. I think the takeaway too is that on some of these transactions, particularly for a lot of our clients, there's cottage property, there's small businesses. Before you make any, substantial adjustments, don't be rushing for the door by, the end of June. Make sure you talk to your advisor, talk to us, talk to your accountant to get guidance on whether you need to be doing things. And I think one of your points was, unless there's a need to initiate an imminent transaction, it's because of necessity or opportunity. It doesn't sound like making knee-jerk reactions. There's not really any win there at all. This is more a frustration or maybe a nuisance, depending on who you're talking to. But probably it's not going to trigger any massive planning for most families. And I think that's kind of one of the takeaways from your overview.
Mm-hmm.
Any last minute comments or last comments before we go to the Q&A?
I'll just echo those comments and say, it's worthwhile exploring to see if it applies, certainly, because significant tax savings could be had depending on your gain that you otherwise be entitled to.
Yeah.
But it's not something that you should rush into because right after this was announced, everyone was panicking, thinking we have to do this,
Yeah.
but then as the days and weeks kind of went on, it's more people are we're running the numbers, and it's not really making sense for a ton of people. But like you pointed out, there's specific scenarios where you can really take advantage of the inclusion rate as it stands today, prior to the increase.
Well, that concludes the recording for the webinar. Hope you found the information helpful. Again, if you are beginning to think about retirement or would like to get some free retirement planning resources, make sure you go to the show notes. There's a link back to our website where you can find out how you can get those complimentary resources or your free retirement income planning forecast. You take care. Bye-bye.